In this week's episode of the Stockscores Market Minutes, the stock market today. Because the market is moving so quickly, it is important to be able to read the market for yourself, and that is what I will teach you in this week's video. Plus, I will do my regular weekly market analysis, and we'll look at the trade of the week on QFIN. The stock market today, it is fast moving, it is volatile, and it can change in the blink of an eye. And that is why you need some simple techniques so that you can read the market through the week. I will update you each week in this weekly video. However, I'm also going to teach you how to do that for yourself, simply using some techniques where really all you have to do is be able to draw on a chart some lines with a ruler. So let's take a look at how to do that. The core components of that are trend lines, inflection points, understanding time frames, and support and resistance. And we're going to keep it simple. Let's look at a chart and just go through these concepts. So the first thing is what I call an inflection point. That is where price changes direction. So if price is going up and it stops going up and goes down, you have an inflection point top. If price is going down and it stops going down, you have an inflection point bottom. So we start with inflection points. We can define all of the inflection points on this chart, and then we can draw a line across them to define a trend line. So there you have a downward trend line, and here you have an upward trend line. Pretty simple so far. What we look for are breaks of trend from either falling tops or rising bottoms. So you can see that on the left side of our screen, we had an upward trend, which we broke here from a falling top. This inflection point was lower than this one. And then here, we broke this downward trend from a rising bottom. We had a bottom here that was lower than this one. This is a buy signal. This is a signal to short or be bearish of the market. Now, the final thing I want to talk about is time frame. Notice that this is a 2-day, 2-minute chart. It is very short term. It is the chart that I like to watch when I'm day trading. But if you are a longer term trader, then this is not really the appropriate chart. If you are what we call a swing trader, where you are holding stocks for days or weeks, then you should look at the 13-minute chart. So this is a 15-day, 13-minute chart. And again, we can define inflection points, draw a line across them. And we can do that for tops as well. Pretty simple, just draw lines on the chart. Now notice it doesn't always work. We had the break of an upward trend line there, but notice that this top was higher than the previous one. We want falling tops before the break of an upward trend line. So there was an upward trend line. I've joined it across those inflection points. It was broken there, and that was from a falling top, and the market went down. Then we broke here, this little downward trend line from a rising bottom right here, and the market went up. Simple technique that you can use to analyze any stock, any market. It doesn't work in a normal market as well as it works in this very volatile market because we have such big price moves. Let's look at it on one more time frame. This is the daily chart. And again, we had rising bottoms, we broke it. Now we didn't have a falling top, so it didn't work there, but here we had the falling top, there we had the breakdown, and that led to the biggest part of the downward move in the market. Then we had a downward trend line here, which we broke a few weeks ago from a rising bottom. Another rising bottom is formed. If we can break this and move up through 290, then the market should then go up to the next level. So that's a simple technique to use. All you have to understand are inflection points, rising bottoms, falling tops, trend lines, and then apply it to the chart time frame that is appropriate for you. If you're a day trader, 2-day, 2-minute. Swing trader, 10, 15-day, 13-minute or 15-minute. And if you are a position trader, a longer term trader, then look at that daily chart. All right, let's get into this week's market analysis, starting us off with the S&P 500. We can basically do what we just did here. You can see that the downward trend line was broken And we've been in an upward trend, which was broken this past week. Not really from a falling top yet. We have managed to claw our way back most of the losses that happened at the start of the week, but we haven't broken through this high yet. We're essentially in a sideways trading range. We've been bouncing up and down in this range. If we break down through 270, that's a negative. I think that means the market likely to go lower. If we can break out through 285 with some strength from a rising bottom, then I think that means the market goes higher. It's hard to say what's going to happen. The trend into the sideways move was up, and so the most likely direction of the next move will also be up. But until we get that breakout through that ceiling price just above 285 on the SPY, I'm not going to get too optimistic, so I'm neutral right now. Longer term, you can see that the market sold off significantly. We all know about that. And it has retraced about half of what it lost. And this is using Fibonacci ratios. We expect it to retrace about half. And that's why it is getting stuck right now. It's just the psychology of the market. The market went down this much. It made back half of its loss. And that's why we tend to stall at that level. So this is also a neutral chart right now. Looking at the Russell 2000, this is the daily chart of the Russell. This is, of course, the small caps in the US. We had a downward trend line broken right there from a rising bottom. That put the market back in sort of the buy zone. And now what we want to see is kind of break through this 125 level on the IWM. If it can, then we might start to recover and make back some more of the losses that we've already made back. Looking at the Canadian markets, pretty similar picture, maybe a little bit choppier. Of course, the Canadian market dragged down a lot by the weakness in oil. But over the last couple of weeks, we've essentially been in this sideways trading range. We've got a little bit of rising bottoms building, but until we can break out through that ceiling price, I would not get bullish. For now, it is a neutral chart. Looking at the longer term time frame, it has not made back as much of the loss. It's made back about a third, maybe a little less than half. But still, it's recovered. But what's next? Hard to say. We need to build that pattern, and if we can then break out from that pattern that I showed on that last chart, then the market has some potential. But for now, neutral long term as well. On the TSX Venture, we're actually recovering fairly nicely the last little while. That's largely because of strength in the mining sector. Of course, with all these governments taking on more debt and printing more money, that's helping gold, and that helps many of the stocks that are listed on the TSX Venture. We're also seeing a little bit of stability and perhaps even some buy interest in the cannabis stocks, which are heavy in this market as well. And so perhaps that beat up sector, the cannabis sector, is starting to make a recovery. On to currencies. US dollar had a lot of volatility right here. That demonstrates uncertainty. And now we've gone back into a very tight trading range, kind of like where it was before, essentially at resistance. So we're basically back where we were before all of the froth that happened with the COVID-19 correction. And I would say that this is a neutral to slightly optimistic chart. It does have rising bottoms, and therefore the buyers are in control of the US dollar. We cannot say that for the Canadian dollar. You can see here on the weekly, we broke down through support from a falling top. That led to this big decline. We've bottomed. We're trying to build a rising bottom, but until we break this downward trend line, I remain a bear on the Canadian dollar. Interest rates, the higher this chart goes, the lower interest rates go, and you can see that it is in an upward trend. And therefore the buyers are in control of the bond market, and that means interest rates are low and looking like they can even get lower. On to commodities, and gold is doing well with all that money being printed. It is a choppy market. It's got a lot of volatility. Great for traders, can be a little bit hard to handle if you are a longer term investor because you can see some big swings in your holdings in this sector. But the direction is what you want to see. The bottoms are rising from left to right. That means the buyers are in control, and therefore I would still be bullish of gold, but I do think it is risky because of that volatility. Oil, exact opposite. It is an absolutely brutal market. Of course, Global demand for oil is so much lower. People are not driving to work, not driving to school. The consumption of oil is very much lower than normal, and they're running out of storage. Where do they put the stuff that they pull out of the ground? So prices are very low, and you can see that until we can break this cycle of falling tops, break that downward trend line, we should remain a bear on oil. It is oversold. It does deserve to bounce one of these days, but it is showing no signs of that. We had a little bit of a bounce here, but there was no rising bottom. There was, in fact, falling bottoms. So you need that build of a rising bottom and then a break of the downward trend line before we can get optimistic on oil. And finally, the fear chart is relatively high still compared to where it normally is, but certainly off of where it was, and that is, I suppose, something positive to be taken from that. The general direction of this is largely dependent upon what the overall market does. If we get more of a correction, this will come alive again. It is a good hedge against market weakness, but I don't see a reason to be a buyer of this today until the market starts breaking down through that 270 level on the SPY. And as long as it can hold that level, I think that the VXX will start to slowly move lower again. So my ratings then neutral on both time frames for Canadian and US stocks. On gold, I am bullish on both time frames, although initiating positions now is a bit risky unless you are a short-term trader. Bearish on both time frames for oil. It is heavily oversold, but there is no sign of strength to be had in oil. Stocks bounce back well. They have recovered about 50% of what was lost through the market crash. The upward momentum has slowed and volatility is starting to normalize. There is still a lot of action each day for short-term traders. We're seeing a number of stocks make big moves every day, and so it's a great environment for trading, but you've got to be picky and selective and ultimately be careful with what you do. If your stock breaks through support, you got to take the loss and try again later. Oil is suffering while gold moves to new highs and fear is coming down. All right, well, let's do our market scan this week. And what I want to do is build a little market scan. We have preset scans on Stockscores, and if you are an active trader member, you get access to the active trader scans. If you are an investor member, you get access to the investor scans. However, you can also build your own scans. And because we have a unique market condition right now, I'm going to show you a little scan that I built this afternoon, which looks for ways to find stocks that have been really beat up but are starting to show signs of stability. So we can jump over to the market scan tool, and I've started to set this up already. You can see here that we have activated certain filters. Let me just highlight them for you. So I've set price to greater than $3, no particular reason, that's just what I chose, but you could select between 1 and 5 or greater than 10, that's totally up to you. Candle, I've set to bullish candle. And then here's one of the keys, gain loss greater than 5% over the last 1 day. So in other words, stocks that had a good day on Friday that made gains. However, that's not enough. We also want to see stocks that have been doing poorly lately. And so what I've done is I've set all of my trends to bearish. So short trend, medium trend, long trend, all bearish. That means the moving averages are all pointed down. Now I put in a liquidity requirement, number of trades, at least 5,000, so stocks that trade fairly actively. You could lower that, perhaps if you're looking at just the Canadian market, you might lower that to 500 or even 200. I didn't want to get a ton of candidates, so I set this to 5,000. We then run the market scan. By the way, I could give it a name if I wanted. I could type in a name there. I could then click on Save the Scan for future use. Just click on that. I'm not going to do that right now. Run the market scan, and it found 61 stocks. So now we are going to go through these charts looking for stocks that may be breaking downward trend lines from rising bottoms. So let's take a look at NMRK. You can see that it first broke this downward trend, but no rising bottom. It then built a rising bottom here and broke this downward trend line just barely right there. It has since receded, but you can see it's now starting to turn up again. So this is a pattern I'm seeing a lot lately. Stocks that were really beat up, they had their initial bounce in the middle of March. They then had the second bounce early in April. And now it may be that they're finally starting to build momentum to the upside. Now, another way to watch for that pattern is to go look at the 15-day chart and look for whether there is a break of a downward trend line from a rising bottom. And there is. You can see on Friday this stock broke its downward trend line with good volume after building a little rising bottom. Now, this is a 15-day, 60-minute chart. So for the swing trader, it's a pretty good setup. I think this stock has a good chance to get back up to the 440 level where it was just 2 weeks ago. That's a pretty good gain from where we are now at 350. An interesting swing trade idea. And you're going to see lots of these patterns right now. I can continue to look through. Here is ENDP. Very similar pattern. The first break of the downward trend line was here, but not from a rising bottom. Then we broke this downward trend line there from a rising bottom. Haven't gone too far yet. And then late last week on Friday, we started to break through this $4 ceiling price. That's a good indication that this stock is in turnaround mode, another decent opportunity. And we'll just cycle through. I'll just highlight some that have similar patterns. Here is EVRI, similar pattern building. Keep an eye on that one. You can spend your time doing this on your own as well. Look through each chart a little bit more quickly. I don't want this video to be too long. Bed Bath & Beyond, trying to do that. I would say we want to take a look at the intraday chart here just to see how that looks. There's the intraday chart. I draw a line across my tops. If it's, well, maybe it won't let me. Sorry, my drawing tool just died. But you can imagine a line being drawn across this top, and you can see that we've broken that downward trend line, and we are now breaking up from rising bottoms. I think this stock could get to 640 in the next 1 to 2 weeks. Pretty good chance of that, perhaps a 70% chance of that. So that's the kind of thing that I think is working well right now, and you can try to do that scan on your own if you are a member of Stockscores. Go into the market scan, just build it as I've shown it to you, save it, give it a fancy name, and you'll be able to use it over and over again. All right, now it's time for our day trade of the week. And let's jump back over here. So this is QFIN, which was a day trade on Friday. It is a picture-perfect setup for my day trader strategy. What we look for is an action candle, which we had right here at the pink dot. And you can see it was breaking through resistance from rising bottoms. Hear that same theme over and over again. And in that case, the entry price was $7.83. For $100 of risk, the position size was 2,000 shares, which is a larger position, $15,660. But remember, you can margin these 3 to 1 when you are day trading. So you put up 1/3 the capital. That required $5,220 of capital. It ended the day at a 21.6 RR gain. That is reward for risk, which is a $2,160 profit on capital required of $5,220, a 41% return for a one-day hold. And that is pretty good. Well, that has been the Stockscores Market Minutes for April 27th. I hope you're enjoying the market. It is certainly fun if you are a short-term trader. Hope you enjoyed this video. If so, click on the like button, subscribe to the channel, and most importantly, trade well.